So Vishwanathan, welcome to the show. Thank you so much for giving us this interview. Let's begin with the fine print, right? The higher borrowing costs. Are we going to see that being passed on this quarter? Can we expect NIMs to normalize at 6% plus? That's something else the street is watching out for.
Borrowing cost, some of the increase has been transmitted. So last quarter we increased the rates for existing customers by 25 basis points, and this quarter, the quarter that went by, we increased by 50 basis points. So overall, we have increased by 75 basis points. We are watching how the rates are moving up, and we are just transmitting just enough to maintain the margins that we have been maintaining earlier. So we are yet to take a call on what we are going to do this quarter in terms of transmitting the borrowing cost. So as of now, we have been able to maintain the margins at about 5.7%. The spreads at 5.7%. So we will wait and see how things move, how the inflation figures move, etc., and then we will take a call on further transmission.
Right. Manoj, in addition to that, I'm just going through your numbers right now. You continue to guide for a 30% plus growth going forward. What kind of levers do you think are going to aid this performance for you? And what makes you so confident of achieving this number?
Distribution is the key to growth. We have been increasing our distribution as per our strategic plan that we created a couple of years ago. The plan is to reach about 400 distribution points, and we are currently at about 261 as we speak. So that plan is being executed quarter on quarter, and we are going deeper in all the markets where we are present, all the states where we are present. That is aiding the growth. The market has also been growing very well in affordable housing, and that's also contributing to the growth. And the third aspect is capturing market share. So our market shares have improved, compared to a couple of quarters ago, and that has been, something that we have been focusing on, improving market share in the markets where we are already present. So I think these are the three levers to for our growth.
Just playing devil's advocate here, because our understanding is that over 90% of your loans are approved within 48 hours of applying. Because you are growing at a brisk pace, clearly. But don't you worry about credit quality getting challenged? And where is it that you see your long-term credit cost trend at?
Credit quality has been holding up, and I think the biggest test, for our processes and credit quality has been the COVID cycle itself, and we have come out of that, doing quite well. So at present, our credit quality, in terms of if you measure it by the 90-day past due, it's the performance is very close or very similar to the pre-COVID levels, so which gives us comfort. We have also been looking at the vintage charts and performance by vintages, which again are mirroring the performances prior to COVID, so which also gives us comfort. And overall, at a ground level, if you look at customers, their behavior, repayment behavior, etc., it's all back to pre-COVID levels, giving us a lot of comfort on the credit quality. As far as approval, quick approvals are concerned, it's a function of the process and the technology that we use. We are able to turn around the loans quickly for customers, and it's one of our USPs in the market. We continue to focus on that and try to provide a very smooth and seamless experience for customers.
Hi, morning. Now your customer retention is quite high. Your transfer rates, though, are lower than their peers who are charging a higher prepayment penalty. What do you believe is driving this higher retention, and is it sustainable?
Our philosophy on retention has been that we want to provide the customer an opportunity to prepay the loan on their own, rather than them having to resort to transferring the loan to a cheaper lender. So from the beginning, from the inception of the company, we have actually provided a zero prepayment charge option to customers, and customers are allowed to pay or repay or prepay loans even at very small quantum of prepayment they're allowed to do. We have an app which has a unique feature of making the prepayment on the app itself. So customer does not even have to come to us. If they have some extra funds with them, they can quickly open their app and make a prepayment, and it immediately gets deducted from the principal amount. So this facility is used by a lot of customers, and customers feel comfortable that they can keep reducing their loans with us, and which has a bigger benefit in terms of overall interest that is paid in the entire tenure of the loan, rather than moving to a cheaper lender. So this philosophy is actually, or this ideology has actually helped us retain more customers.
Given a 4% return, if you look at it in the last 1 year. Thanks so much for joining us today and being live with us. 4% uptick today as well after those solid numbers.